The Fed is signaling a pause in raising interest rates, and as a result, the stock market has responded positively. Given the potential for improved markets, now might be a good time to reconsider your high-growth ETF options. That's why I'll be discussing the top 5 ETFs within the high-growth technology sector. My criteria for selecting these technology ETFs boil down to 4 main points. Firstly, the ETF must have a majority of holdings in technology companies. Secondly, I am excluding any leveraged ETFs, even if they are in technology. Thirdly, the selected ETF must have the highest ranking score among its peers. This score is a weighted measure that I've created based on total returns year to date, 1 year, 3 years, 5 years, and the expense ratio. Lastly, there is a focus on diversity in the companies within the top 10 holdings. This means there shouldn't be significant overlap in the top 10 holdings for each ETF. If I were to pick the top 5 technology ETFs without this criterion, they would likely all have the same holdings, rendering them nearly identical. That's why I've excluded funds like QQQ and QQQM from my list, as they share nearly identical companies with another ETF that has an even higher score. For those questioning why a specific fund was omitted from my list, it's solely due to these 4 criteria, not personal preference. I'm taking an objective point of view, following the model criteria to ensure diversity and optimal performance. I believe most of you will appreciate this approach, and I hope you discover 1 or 2 new ETFs for your portfolio. Moving on, it's important to note that within the technology sector, I see 3 areas with massive growth potential over the next decade: artificial intelligence, robotics and automation, and quantum computing. These are the areas I focus on in my investments. Now let's dive into the first ETF on the list, the First Trust Technology AlphaDex Fund. This ETF tracks the performance of the StrataQuant Technology Index, a tiered, equal-weighted index of large and mid-cap US technology firms. Interestingly, many of the top 10 holdings aren't mega-cap companies typically associated with technology. However, Palantir Technologies stands out as a top holding, a software company specializing in big data analytics and artificial intelligence. I view this as a significant catalyst for the long-term potential of this specific ETF. I'll present the performance of the FXL ETF during the recording of this video, noting the lower dividend, which is typical for most technology ETFs due to companies reinvesting their profits. While the PDE ratio is slightly higher compared to the S&P 500, what surprised me was the beta being below 1. For context, I'm showcasing the VOO ETF as an S&P 500 index for comparison. It's crucial to remember that a higher PDE ratio indicates the market sees these companies as valuable, factoring in their future growth. With a beta below 1, this ETF experiences smaller pricing fluctuations compared to the market. However, we anticipate that most technology ETFs will have a beta greater than 1, resulting in larger pricing fluctuations, both positive and negative. Examining the total returns, please note these are annualized total returns with expenses already deducted and assuming all dividends are reinvested. This approach levels the playing field for comparison. I emphasize this because I often receive comments, especially in this video right here, claiming that high-paying dividend ETFs outperform high-growth technology ETFs due to dividends. This isn't accurate, as dividends are already considered in the annualized total return. You won't receive anything beyond the annualized total return. As illustrated, the FXL fund has outperformed the S&P 500 in every year except over the 3-year time frame. I confess that this fund wasn't on my watch list before creating this video. I appreciate its unique mix of holdings compared to most other technology ETFs. The inclusion of many mid-cap companies provides ample room for substantial growth. Now, let's move on to the next ETF, the First Trust NASDAQ, 100 Technology Sector Index Fund. This ETF monitors the performance of the Nasdaq 100 Technology Sector Index, an equally weighted index of the largest Nasdaq-listed U.S. technology stocks. Notably, the top 10 holdings of TRAQ differ significantly from the previous ETF. CrowdStrike, a cybersecurity company based in Austin, Texas, takes the lead with a focus on cloud workload and endpoint security, threat intelligence, and cyber attack response services. With over a decade of experience, CrowdStrike is poised for rapid growth as the demand for cybersecurity and protection against cyber threats continues to rise. Examining QTech's performance, we observe higher risk factors such as beta and PE ratio compared to the previous ETF, and a notable contrast with the S&P 500. Despite major year-to-date growth, the 3-year total annualized return is slightly lower than the S&P 500 for similar reasons. However, the 5-year total return is impressive, turning a $10,000 investment 5 years ago into over $22,000 today. QTech has consistently performed well, and I appreciate the limited overlap in their top 10 holdings with other technology funds, adding diversity to my portfolio. Before we proceed, I have a small favor to ask. If you appreciate my content, kindly consider hitting the like button to support the growth of my YouTube channel. Even better, I'd love it if you could subscribe to stay updated on all my latest content. Now, let's delve into the next ETF, the Defiance Quantum ETF, QTUM. This ETF tracks the performance of the Blue Star Quantum Computing and Machine Learning Index, an equally weighted index of companies involved in the research and development or commercialization of systems and materials used in quantum computing. True to its name, QTUM offers a diverse mix in its top 10 holdings compared to others. Examining QTUM's performance at the time of filming, there's nothing particularly unusual about expenses, dividends, or beta. However, the prior year's performance stands out slightly more than the other two ETFs. If you had invested $10,000 5 years ago, it would now be worth over $24,000. While the ETF emphasizes quantum computers, it also focuses on AI and automation, aligning with significant growth drivers. Now let's discuss the fourth ETF for today, the iShares US Technology ETF, or IYWW. This ETF monitors the performance of the Dow Jones US Technology Index, a market cap-weighted index encompassing the largest publicly traded companies in the technology sector of the US equities markets. A glance at the top 10 holdings reveals familiar names like Apple, Microsoft, Alphabet, and Nvidia, aligning with the trend of top-performing technology ETFs reflecting these holdings due to their substantial growth over recent years. In terms of IYW's specifics, details such as dividend, PE, beta, and expenses follow a similar narrative. However, where it truly distinguishes itself is in its returns. Across the board, from year-to-date to the 5-year annualized total returns, it stands out as a powerhouse. A $10,000 investment 5 years ago would now be nearly $30,000. IYW is one of those top ETFs that isn't getting the attention it deserves. Based on my criteria for selecting an ETF, it surpassed QQQ due to its superior performance with nearly identical holdings. Moving on to the next ETF, let's review the VanEck Semiconductor ETF with the ticker symbol SMH. This ETF monitors the performance of the MVIS US listed Semiconductors 25 Index, with the top 10 holdings specific to the semiconductor industry. While there is some overlap with other ETFs, it's not significant. Notably, SMH places considerable weight on its top 2 holdings, which can be both its guide to success and its largest risk. Regarding the performance of the SMH ETF, the numbers are similar, but the beta is the highest in the group, indicating the potential for the highest highs and the lowest lows in pricing. These types of ETFs are designed for long-term investors. Looking at the returns, this ETF stands out on another level, almost beating every other ETF covered. If you had invested $10,000 5 years ago, it would now be worth over $35,000, nearly twice the return of the S&P 500. After discussing this ETF, I will provide a comparison of all the ETFs covered, so you can see how they stack up against each other. If you're interested, let me know in the comments if you want to see the comparison I conducted for all 150 ETFs in the making of this video. Overall, I believe I've presented a few ETFs that you may not have considered before, thanks to the additional layer of uniqueness I applied within their holdings. I hope you found value in this video. Feel free to let me know in the comments if there are any other sectors you'd like me to explore in depth.